The statement of cash flows is the only statement that ignores the accrual principle, because all you need to report is real cash in or out. What do IFRS say about cash flows and how should you report them? Well, let's find out in this video about a summary of IAS 7 statement of cash flows. This is Sylvia of IFRS Box, and if you'd like to learn IFRS fast, then you're welcome to check out my web ifrsbox.com. First of all, you should know that the statement of cash flows is an integral part of financial statements, and it means that complete set of financial statements cannot be complete without cash flows. And what's the main benefit of it? Why to prepare statement of cash flows, apart from the fact that it's obligatory? Isn't balance sheet and income statement sufficient? Well, the statement of cash flows shows the ability of any entity to generate cash. How does the company generate cash? By selling its products or providing own services? Or by taking new loans? Well, which one would you choose to invest in? Well, that's obvious. In general, the company that generates cash from operating activities wins, isn't it? Now, statement of cash flows is prepared always for the certain period. For example, for the year from 1st January 2004 until 31st December 2004. Such a statement should show you how the company generated cash and where the cash was spent over that period. In fact, it shows you the movement of cash and cash equivalents from 1st January till 31st December 2004 in this case. As every other component of financial statements, also the statement of cash flows must contain the same identification marks. There must be a name of the reporting entity. Also, it must be clearly stated whether we look to the group or individual statement of cash flows. It must contain the title, statement of cash flows, then the period covered by the statement, and finally, there should be stated what the reporting currency is and the rounding used in presentation of numbers, so whether figures are presented in thousands, millions, etc. Fine. Now let me explain how IAS 7 defines cash and cash equivalents, and it's slightly more complex than you would expect. Obviously, cash and cash equivalents include cash, which comprises of cash on hand, basically petty cash, and demand deposits, that's current bank accounts including. Cash equivalents are short-term highly liquid investments that are readily convertible to known amounts of cash and are subject to an insignificant risk of changes in value, while investment would normally qualify for cash equivalent only when it has a short maturity, no more than 3 months from the date of acquisition. Equity investments, like shares, are basically excluded from cash equivalents with some exceptions, for example, preferred shares acquired within a short period of their maturity and with specified redemption date. The statement of cash flows excludes movements between items that constitute cash or cash equivalents because these are part of the cash management rather than part of its activities. Let's describe the statement of cash flows itself now. IAS 7 prescribes that we should report cash flows in 3 main parts: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Operating activities are the principal revenue-producing activities and also activities other than financing and investing, while this part is the key indicator and shows whether operations of the entity generate enough cash to repay loans, pay dividends, and make new investments without external money. So what transactions enter into this part? Cash receipts from the sale of goods and rendering of services, cash receipts from royalties, fees, commissions, and other revenue, cash payments to suppliers of goods and services, and to and on behalf of employees, so also payment to social security institutions or tax authorities, cash payments or refunds of income taxes unless they can be specifically identified with financing and investing activities. Here also other cash flows might enter, and the operating part is probably the most complex one. Investing activities represent the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Well, basically, these are cash payments to acquire property, plant and equipment, intangibles, and other long-term assets. And if an entity is developing certain assets itself, payments related to development costs and self-constructed property enter also to this caption. Equally, any proceeds from sale of property, plant and equipment, intangibles, and other long-term assets are part of investing activities. Payments to acquire are also most receipts from sale of equity or debt instruments of other entities or interest in joint ventures. Again, there's a little trick, because if you buy some shares just to sell them later, so you hold them for trading or dealing purposes, it is an operating activity and not investing, so be careful about the classification. Then cash advances and loans made to other parties and receipts from their repayment. Well, but if you're a financing institution like bank, this would go to operating activities because such transactions are probably your revenue producing. Next, cash payments and receipts related to derivative contracts such as futures, forwards, options, and swaps belong to investing activities. But again, if those are held for trading, then they are reporting under operating activities. And careful, because this also applies to some hedging relationships too. Financing activities are activities that change the size and composition of the contributed equity and borrowings of the entity. So first of all, cash payments to or receipts from equity owners related to issuance of new shares or their redemption belong here. Sure, this is true also for other own equity instruments. Then cash receipts from issuing debentures, loans, notes, bonds, mortgages, and other short or long-term borrowings, and also repayments of these amount borrowed enter here. Finally, lessee's payments for the reduction of the outstanding finance lease liability enters into financing activities too. Now let's take a look at how statement of cash flows can be presented. So here's the example of presenting the statement of cash flows in the financial statements. First of all, please note, here are all the identification data as required by IAS 1. So the name of the reporting entity, then CO stands for individual and not group statement of cash flows, the period for which the statement is presented, year ended 31st December 2004 and 2003 as the comparatives, and of course presentation currency euro in this case, and level of rounding thousands. Next, the statement itself contains 4 parts. First, cash flows from operating activities. Second, cash flows from investing activities. And the third one, cash flows from financing activities. And at the end, there is always a reconciliation of cash and cash equivalents balance between the beginning and the end of the reporting period. There's a line, effect of exchange rate changes on cash and cash equivalent, and this is the place where you report foreign exchange rate changes on cash and cash equivalents. For example, some foreign exchange gain or loss on bank accounts in foreign currencies. Then there's a line net increase, could also be a decrease in cash and cash equivalents, and it is the sum of results of all 3 parts, operating, investing, and financing. And the other 2 lines represent balance of cash and cash equivalents at the beginning and at the end of period. Standard IAS 7 requires disclosure of structure of cash and cash equivalents at the beginning and at the end of period, such as shown here, right? So it's sufficient to include this disclosure in the notes to the financial statement, so you don't need to do that on the face. Let's take a look to 2 ways of reporting cash flows from operating activities. You can report them by direct method. Here, major classes of gross cash receipts and gross cash payments are disclosed. An indirect method, where you could start with the profit or loss before income tax, and then you adjust it for non-cash items such as depreciation, any deferrals, accruals of past or future cash flows, and any items that are associated with investing and operating activities. Now let's take a look to investing and financing part. Cash receipts and cash payments from investing and financing activities shall be reported gross, so no netting off. So that means that cash inflow is presented in one line and the cash outflow from the same activity in the other line. For example, you need to present cash payments for the acquisition of property separately from proceeds from sale of such property. But here, the standard IAS 7 allows a few exceptions where you can report on a net basis or in one line. For example, when the entity makes some cash flows on behalf of its customers, and those reflect the activities of the customer rather than those of the entity. Some rents collected on behalf of and paid over to the owners of properties, just as an example. Secondly, cash payments and receipts for items in which the turnover is quick, the amounts are large and maturities are short, for example, credit card transactions in banks. And then the financial institutions are the special case themselves because they might report some cash payments and receipts from various selected cases on a net basis. Let's go through a couple of other issues when reporting cash flows. Many entities enter into foreign currency transactions, so when we deal with foreign currency, we shall always apply foreign exchange rate valid at the date of transaction to translate the amount in the foreign currency to the amount in the functional currency, right? The things are different at closing because unrealized gains and losses from foreign currency exchange rate changes are not cash flows, and you need to make non-cash adjustments basically. Cash flows from interest and dividends received and paid shall be each disclosed separately, so here no netting off is allowed. And also let me say that these cash flows shall be classified consistently from period to period as either operating, investing, or financing activities, so you have a choice basically here. Another issue, when an entity has an investment, there is a question what to do with cash flows of this investment in subsidiary, associate, or joint venture. Well, it depends on the accounting method. For example, when a company accounts for investment in an associate or subsidiary using equity or cost method, then the investor restricts his reporting to the cash flows between himself and investment, dividends and advances, right? So that was the short summary of IAS 7, the statement of cash flows. Thank you very much for watching this video, and if you want to take your IFRS knowledge a little bit deeper, then learn IFRS with me and sign up for email updates at ifrsbox.com. Many bonuses included. Thanks again and have a nice day.